Inflation is not dead, it is dormant. Lazard is basically carries a deceptively calm message. Inflation could surprise to the upside. And when inflation surprises, portfolios break. So I want to walk through why Lazard Frère is basically quietly warning that inflation could reaccelerate toward 4% by the end of 2026. How to read this chart properly, and more importantly, why nearly every standard asset allocation framework is not prepared for this outcome. At the top, you could see what Lazard states in their thesis. And this is CEO of Lazard talking. If you look at it, it basically is saying that the risk of higher inflation in 2026. And of course, 4% potential inflation rate by the end of 2026. This is not a forecast line. This is not a conditional risk scenario. Lazard is not saying inflation will be 4%. They're saying the distribution of outcome is asymmetric and skewed upward. In other words, the downside risk to inflation is limited. The upside risk is underappreciated. Markets are priced for a cleaner disinflation path than fundamentals justify. Then comes the most important sector of it, factors to consider. It's not a checklist or a causal chain. Each factor reinforces the other. Factors to consider, as you could see. Think of this slide as a bullet, not as a bullet point, but as a stacking pressure plates. The first factor, lagged effect of tariffs. Tariffs do not behave like interest rates. They do not transmit cleanly or immediately, right? Tariffs move through the system in 4 stages. And these are the stages. So number 1, absorption by exporters. Number 2, temporary margin compression by importers. Number 3, inventory smoothing. Number 4, final pass. There's a final price pass through to consumers. We're currently in stage 3, inventory smoothing right now. That means that CPI understates future pressure. PPI leads CPI with long lags. Corporate earnings absorb pain before households do. And they're absorbing it right now. Historically, tariff-driven inflation shows up 12 to 24 months later, not immediately. Markets, however, price tariffs as they are on one-off shocks. That's a mistake. Tariffs are structural cost increases, not cyclical ones. And we've seen that in the 70s and the 80s. So the next factor is expansion in fiscal deficit. What does that mean? That's basically saying that fiscal deficits expand during full employment, which we have now. Inflation risks rise exponentially. Why? Because fiscal stimulus adds demand without increasing productive capacity. It forces monetary policy to work harder. It weakens the credibility of disinflation commitments. We are no longer in a counter-cyclical regime. We are in a structural deficit regime. And that matters because Treasury issuance pressures long-term yield. High yields increase cost pass-through and deficit entrenched inflation expectation. Fiscal dominance is not a theory anymore. It's an observable condition. Of course, on top of that, you've got tighter labor market. That is where many inflation model fails. Headline employment data misses labor quality constraints, skilled labor shortages, demographic drags, immigration bottlenecks. Wage inflation does not need unemployment at 3%. It needs bargaining power asymmetry. And this asymmetry has shifted toward labor. Once wage inflation embeds itself, it does not unwind clearly, meaning that you are more to make more money because you think you need more money, and because they're giving you more money, then they're going to expect more money to be paid out, and they increase their costs, right? And then everything else becomes more expensive. Looser monetary policy. This does not mean reckless easing. It means policy constrained by debt service, markets, and politics. The U.S. owes $37 trillion, almost $38 trillion. Central banks are no longer operating in a vacuum. They are constrained by financial stability risks. sensitive to asset market volatility, and managing fiscal monetary interaction. Even if nominal rates remain high, real rates fall when inflation expectations rise. That is loosening. And the final factor is the most dangerous one, rising household inflation expectations. Inflation expectations are not linear, they are regime-based. The last point at the bottom, right? Once households stop believing inflation is temporary, price sensitivity drops, wage demands increase, I want to get paid more money, consumption times accelerate. This is how inflation becomes self-reinforcing. And that is why central banks fear expectation more than prints. Once expectations de-anchor, the models fail. And why? So why is this 4% plausible? 5 reasons. 5 reasons. Tariffs raise costs. Deficit raise demand. Labor tightness raises wages. And policy constraint reduce tightening capacity, and expectations lock in behavior. This is not the 1970s we played, but it rhymes. And a 4% inflation regime is enough to break duration-heavy portfolios, compress equity multiples, undermine the 60-40 assumption, reprice risk premium, and this is not a tail risk anymore. It's a fat tail risk. It's a black swan. So Lazard is not making a sensational call there. They're making a professional warning. I mean, the most dangerous period for investors is not high inflation. It's the belief that inflation is solved when it's merely paused. If inflation surprises to the upside, it will not do so gradually. It will do so when positioning is most complacent. That is a real risk.